Right now, while you're watching this video, a financial earthquake is happening. And it's not coming from Wall Street. It's not coming from Washington. It's coming from Tokyo, and most people have absolutely no idea what's about to hit them. Here's what just happened. Japan's 30-year government bond yield just crossed 3.5%. Now, if that sounds boring to you, I need you to stick with me for the next few minutes, because this single number is about to change everything about your money, your investments, and the global economy. This is the biggest financial story that nobody is talking about, and by the end of this video, you'll understand exactly why this matters to you and what you need to do right now. But before we dive deep into this, do me a favor. Hit that subscribe button and tap the bell icon. I'm going to break down complex financial events into simple terms you can actually use. And trust me, you don't want to miss what's coming. Also, smash that like button because this information needs to reach as many people as possible. The mainstream media isn't covering this properly, so we need to spread the word ourselves. All right, let's talk about what's really happening. For the past 2 decades, Japan has been the world's ATM machine. Think about that for a second. While every other country was dealing with normal interest rates, Japan kept their rates at 0. Sometimes they even went negative. That means people were literally paying the Japanese government to hold their money. Sounds crazy, right? But here's where it gets interesting. This created what financial experts call the carry trade. And this carry trade is the hidden engine that's been powering global markets for 20 years. Let me explain how this works in simple terms, because once you understand this, everything else will make perfect sense. Imagine you're a hedge fund manager in New York. You want to buy stocks, real estate, or crypto, but you don't want to use your own money because you're smart and you want leverage. So you look around the world for the cheapest loan you can find. And there it is, shining like a beacon. Japan, offering money at basically 0% interest. So here's what you do. You borrow 1 billion yen from Japan. It costs you almost nothing in interest. You take that yen, convert it to US dollars, and then you use those dollars to buy American assets that are paying you 5%, 10%, or even more. You pocket the difference. It's literally free money. And this isn't just a few hedge funds doing this. We're talking about trillions of dollars flowing out of Japan and into Western markets through this exact mechanism. This is why US tech stocks have been soaring. This is why real estate prices have been climbing. This is why crypto went to the moon. A huge portion of that money came from borrowed Japanese yen. Japan was printing the money, the world was borrowing it, and asset prices everywhere were inflating like crazy. But here's the catch, and this is where everything falls apart. This whole beautiful scheme only works under one condition. Japanese interest rates have to stay low. The moment those rates start rising, the cost of borrowing that money goes up. Suddenly, your free money isn't free anymore. And if the yen gets stronger against the dollar, you owe back more money than you originally borrowed. That's the nightmare scenario. And guess what? That nightmare is happening right now. The Bank of Japan has lost control. Inflation is forcing them to raise rates. The 10-year yield just crossed 2.13%. The 30-year yield is at 3.5%. These are numbers we haven't seen since 1999. The game is over. Now, all those hedge funds that borrowed trillions in yen need to pay back their loans. And to pay back those loans, they have to sell their assets. They have to sell US stocks. They have to sell bonds. They have to sell real estate. This creates a massive wave of selling pressure that has nothing to do with company earnings or economic fundamentals. It's purely mechanical. It's a forced liquidation. It's a global margin call. And before you think this is just speculation, we already have a recent example of what happens. Remember August 5th, 2024? That day is now called Black Monday. The Bank of Japan raised rates by just 0.25%. Just a tiny 0.25% increase. And the global markets absolutely collapsed. The Japanese stock market fell 12% in a single day. That was the worst drop since 1987. Crypto crashed. US tech stocks tanked. Everything fell at once. Why? Because everyone who was playing the carry trade rushed for the exit at the same time. It was chaos. Central banks had to step in and calm things down. But here's what you need to understand. That was just a warning shot. That was a tiny rate increase, and it almost broke the system. Now, in 2026, we're not talking about 0.25%. We're talking about yields that have exploded to multi-decade highs. The pressure is 10 times worse. If a small rate hike caused that much damage, what do you think a breakout to 3.5% is going to do? Let me tell you what's happening right now behind the scenes. Japanese pension funds and insurance companies are looking at their portfolios and making a historic decision. For 20 years, these massive institutions couldn't make any money investing in Japan because domestic rates were 0. So they took their money overseas. They became the largest foreign holders of US debt. They bought European bonds. They bought Australian debt. Japanese investors own over $1 trillion of US Treasury bonds alone. But now, everything has changed. They can get 3.5% risk-free at home in Tokyo. No currency risk, no geopolitical risk, no time zone headaches. Just safe, stable returns in their own currency. This is the magic number that Japanese fund managers have been waiting for. They've been saying for years that if domestic yields hit 3%, they would bring their money home. Well, we just crossed 3.5. The great repatriation has begun. This isn't theory anymore, it's happening. Japanese money is flowing back to Japan, and this creates a massive black hole in the US financial system. Who's going to buy all that US debt if Japan stops buying? China? No, they're selling too. The Federal Reserve? They're supposed to be tightening, not buying. Private investors? They're already maxed out. This is the crisis that's unfolding. When Japan pulls their money out, US interest rates have to spike to attract new buyers. Higher interest rates break the US housing market. They break the banks, they break the economy. A rate increase in Tokyo forces a rate increase in New York. The world is connected by debt, and Japan has been holding the rope. Now, I want you to stay with me here because we're about to talk about why this is actually creating the biggest opportunity in precious metals that we've seen in decades. But first, I need you to do something. If you're finding this valuable, leave a comment below. Tell me what you think about this situation. Are you worried? Are you excited? Are you preparing? I read every single comment, and your engagement helps this channel grow so we can reach more people with this critical information. Also, share this video with someone who needs to understand what's happening. Knowledge is power, and right now, most people are completely in the dark. Let's talk about what this means for you and your money. When this carry trade unwinds, when Japanese money flows home, when US interest rates spike, there's going to be chaos in traditional markets. Stocks will be volatile, bonds will be shaky, real estate will be uncertain, people are going to be looking for safety. They're going to be looking for assets that can't be printed, can't be diluted, and can't be controlled by central banks. That's where silver and gold come into the picture. Now, I'm going to focus more on silver because silver has some unique characteristics that make it incredibly interesting in this environment. In the initial phase of any liquidity shock, everything gets sold. People need cash to meet margin calls. They sell gold to pay for their yen loans. They sell silver. They sell everything. We saw that initial drop recently. But once the panic selling is done, once people catch their breath, that's when the fear really sets in. Investors start asking themselves a critical question. Where can I actually hide? They can't hide in the yen because it's becoming volatile. They can't hide in the dollar because it's being printed to solve these problems. They can't hide in bonds because rates are rising and bond prices are falling. There's really only one place left, and that's hard assets. Physical assets that have intrinsic value. When the global carry trade blows up completely, it destroys faith in paper assets. Capital runs from the leveraged financial economy to the real physical economy. Gold and silver are the ultimate unleveraged assets. They have no counterparty risk. They don't care what the Bank of Japan does with interest rates. They can't be printed or created out of thin air. They're immune to the currency chaos that's coming. This is exactly what happened in the 1970s. Interest rates rose, bonds crashed, and gold went to the moon. We're repeating that cycle right now. History doesn't repeat, but it definitely rhymes. And right now, it's rhyming pretty loudly. But there's more to this story. Let me explain the next layer of this crisis, because it gets even more intense. When Japan sells US Treasury bonds to bring their money home, somebody has to buy those bonds. The US government is running a deficit of about $2 trillion a year. They need to keep selling bonds to pay their bills. They rely on foreign buyers, especially Japan and China, to buy that debt. But China has already stopped buying. They've been selling. And now Japan is stopping too. So who's left to buy? Hedge funds are too leveraged. Banks are already full. Pension funds are limited. There's only one buyer with deep enough pockets to absorb all this selling. The Federal Reserve. This is the trap. This is the corner that the Fed is being pushed into. If foreign demand for US debt collapses, if Japanese investors are selling, the US Treasury market will crash. Yields could go to 6 or 7%. And here's the scary part. At 7% interest, the US government becomes insolvent. The interest payments on the national debt would consume the entire federal budget. Social Security, Medicare, defense, everything would have to be cut just to pay the interest. The Fed cannot let that happen. They have to step in. They have to become the buyer of last resort. They have to create new dollars to buy the old bonds that Japan is selling. This is called monetizing the debt. It's the textbook definition of printing money to pay your bills. And when the market realizes that the Fed is the only buyer left, when investors understand that the supply of dollars is about to go vertical, the value of the dollar is going to collapse. And what's the opposite of the dollar? What's the anti-dollar? Silver and gold. This is why the Japan situation is so incredibly bullish for precious metals. It forces the Fed to print money even if they don't want to. They have no choice. They have to print to absorb all the Japanese selling. Japan is exporting their inflation problem to us. Now, let me introduce you to a term that you're going to hear a lot in the coming months. Yield curve control. Japan has been doing this for years. Now the United States is going to have to do it too. Here's what yield curve control means. A central bank draws a line in the sand and says, the 10-year Treasury yield will not go above 4.5%. If the market tries to push yields higher, the central bank commits to printing infinite amounts of money to buy bonds and keep the yield down. This is the ultimate surrender. It means the central bank has given up on fighting inflation. They're prioritizing keeping the government solvent over maintaining the value of the currency. Once yield curve control is announced, or even hinted at, the bond market becomes a zombie market. Returns are capped. Risk is unlimited. Capital flees. Where does that capital go? It can't stay in bonds because returns are artificially capped. It can't stay in cash because inflation is going uncapped. It has to go somewhere. It goes to real assets. This is the mechanism of what economists call a crack-up boom. The economy might be struggling, but asset prices rise because the currency is being destroyed to save the bond market. Silver is the primary beneficiary of yield curve control. Why silver specifically? Because silver has both industrial utility and monetary history. It's used in solar panels, electronics, electric vehicles, and countless other applications. Industry needs silver to function. But it's also been money for thousands of years. It's the asset that cannot be diluted or printed. As we get closer to yield curve control in the US, and we are getting closer every single day, silver becomes more and more valuable. But let me tell you why silver has even more upside than gold in this situation. Gold will do great, don't get me wrong, but silver has unique leverage on the industrial economy. Remember, this crisis started in Japan, and Japan is a manufacturing powerhouse. Toyota, Honda, Panasonic, Sony, all these companies use massive amounts of silver in their products. As the yen strengthens due to repatriation, Japanese companies gain more purchasing power. They can buy more raw materials for the same amount of yen. This makes commodities cheaper for Japanese industry in yen terms. So a stronger yen actually supports industrial demand in Asia. It allows Japanese companies to stock up on strategic resources, including silver. They're going to be buying aggressively. Plus, silver is what I call the people's hedge. When average citizens see their currency failing, when they see bond yields spiking and markets crashing, they can't afford to buy a house or a bunch of gold bars. But they can buy silver coins. They can buy a few ounces here and there to protect themselves. The retail panic that we're starting to see is fueled by this macro anxiety. When the carry trade blows up, when volatility spikes, regular people get scared and they run to safety. Silver is that safety. So we have a dual driver for silver prices. On one side, there's the monetary aspect. The Fed printing money to buy the bonds that Japan is selling. That's inflationary, and it's bullish for precious metals. On the other side, there's the industrial aspect. Japanese industry using their stronger yen to secure stockpiles of strategic materials. Both roads lead to the same destination, which is higher silver prices. Now, let's talk about the banking system because there's another layer to this crisis that most people don't understand. The global banking system has been built on a foundation of cheap money for the past 20 years. Banks assumed that interest rates would stay low forever. They assumed the Japanese yen would always be available as cheap funding for their risk-taking. They built a massive tower of leveraged bets based on that assumption. Today, with the 30-year yield at 3.5%, that foundation is cracking. Banks are sitting on an enormous derivatives market. We're talking about contracts worth hundreds of trillions of dollars in notional value. Now, to be fair, notional value isn't the same as the money actually at risk, but even the money at risk is huge. We're talking about maybe $20 trillion in gross market value. Most of these derivatives are interest rate swaps. Here's how they work in simple terms. A bank enters a contract where they receive a fixed rate and pay a floating rate. They're betting that interest rates will stay stable. They use massive leverage to squeeze tiny profits out of these trades. But Japan just threw a massive wrench into the gears. By allowing their rates to rise, Japan is pushing up global interest rates. This moves the floating rate against the banks. When you're highly leveraged, even a small move in the wrong direction can wipe you out. We're starting to see signs of stress. Japanese banks have reported huge losses from selling foreign bonds. U.S. banks are sitting on hundreds of billions in unrealized losses from previous rate hikes. The scary part is that in a connected financial system, when one institution gets hurt, everyone feels it. If a hedge fund blows up because the yen spiked and they can't pay back their loan, that loss doesn't just disappear. It travels up the chain to the bank that lent them the money. The bank is left holding the bag. We saw this happen with Archegos Capital a few years ago. One fund exploded and it cost Credit Suisse $5 billion. Now imagine that happening across multiple funds simultaneously. The exposure could be systemic. Banks might start realizing that their clients can't pay them back. This leads to a credit freeze. Banks stop lending to hedge funds. They stop lending to each other. They hoard capital to plug holes in their own balance sheets. When credit stops flowing, the economy grinds to a halt. This puts massive pressure on the Federal Reserve to intervene. Not to save the economy necessarily, but to save the banks from their own bad decisions. The Fed has what they call a dual mandate: stable prices and maximum employment. But they have an unwritten third mandate that's actually more important than the other two: financial stability. Right now, inflation is still above target. According to textbook economics, the Fed should keep rates high to fight inflation. But financial stability is flashing red warning lights. The Japan shock is stressing the banking system. History tells us that when financial stability conflicts with fighting inflation, stability usually wins. The Fed will cave. They'll cut rates or restart quantitative easing to calm the markets. They'll do this even if inflation is above their target. They'll choose inflation over systemic collapse. They're not going to pivot because they want inflation. They're going to pivot because something broke badly enough that they have no choice. And broken financial systems require printed money to fix. That printed money flows into assets like silver. Let me bring this back to something practical for you. Why does a banking crisis specifically matter if you're holding silver? It's all about counterparty risk. If you own silver through an ETF or a pool account or a futures contract, you have a counterparty. Usually that counterparty is a bank or a financial institution. If that bank faces solvency issues because their yen carry trades went bad, your silver could be at risk. It becomes part of their bankruptcy estate. You become an unsecured creditor, standing in line hoping to get your money back. But if you hold physical silver, if you have actual coins or bars in your possession, you have zero counterparty risk. A silver coin doesn't care if a bank is solvent. It doesn't care what the Japanese bond yield is doing. It's an asset that stands completely alone. During a banking crisis, capital runs away from interconnected paper assets and into bare physical assets like gold, silver, and land. This is called the flight to quality. We're seeing the early stages of this flight happening right now. The premiums on physical silver coins are rising because people are waking up to the risk of leaving their wealth trapped inside a stressed financial system. The Japan shock is the fire alarm. Smart money is already checking where the exits are, and the exit leads to a vault, not a bank account. So let's bring this all together and talk about where silver prices could actually go. Because that's what you really want to know, right? What are the targets? How high could this go? Well, history gives us a pretty clear roadmap. Every time the financial system breaks, whether it was 2008 or 2020, the response from central banks is always the same. They print money. And when they print money, silver doesn't just rise gradually, it explodes. Let's look at 2008. The banking system collapsed. Lehman Brothers failed. Initially, silver crashed hard. It fell from $20 to $9 because of the immediate liquidity crunch. Everyone needed cash fast. But then the Fed announced quantitative easing. They started printing money to buy bonds. What happened to silver? It went from $9 to almost $50 over the next 3 years. That's a 500% rally. Now look at 2020. The pandemic hit. Markets crashed. Silver fell to $12. Then the Fed printed $3 trillion in a matter of months. Silver went from $12 to $30 in just 5 months. It more than doubled almost immediately. The pattern is crystal clear. Crisis causes an initial crash. The crash forces central banks to print money. The money printing causes a massive rally in precious metals. The Japan shock is our current crisis. We're in that volatile phase right now where things are breaking. Assets are getting sold. There's panic in certain corners of the market. But the money printing phase is coming. It's inevitable. The Fed cannot allow the Treasury market to collapse. When the printing starts this time, we're starting from a much higher base. We're not starting at $12 like in 2020. We're starting around $70 to $80. If silver just doubles from here, like it did in 2020, we're looking at $150. But I actually think we could see more than a double because this crisis is bigger. The amounts involved are larger, the systemic risk is higher. So let's talk about realistic price targets based on historical ratios. Gold is currently trading around $4,500 per ounce. In a monetary crisis, which is what yield curve control represents, the gold to silver ratio typically compresses. It moves back toward its historical average. Throughout modern history, that average has been around 40 to 1. If we take $4,500 gold and divide it by 40, we get a silver price of $112. That's a conservative target, assuming gold doesn't go higher. But if the crisis gets more acute, if we see actual bank failures or a major economic disruption, the ratio could compress to 30 to 1. 4,500 divided by 30 gives us $150 per ounce. And if we get a true panic, a 1980-style mania where everyone is rushing into precious metals at once, the ratio could go to 15 to 1. That would put silver at $300 per ounce. So the roadmap is pretty clear. First target, $100. Second target, $150. Third target, $300. We're currently in the 70s, which means we're looking at potential returns of 2 times to 4 times from current levels. This is what we call an asymmetric opportunity. The downside is somewhat limited because industrial demand puts a floor under the price. But the upside is essentially uncapped because the currency is being destroyed. However, I need to give you a warning. The path from $70 to $300 is not going to be a smooth, straight line upward. It's going to be jagged and violent and scary at times. As the carry trade unwinds, there will be days where silver drops $5 or $10 in a matter of hours. There will be margin calls that force funds to sell their winning positions. There will be shakeouts designed specifically to scare you out of your position. The big banks and institutions want you to panic and sell your physical silver so they can cover their paper short positions cheaply. When you see a big red day, when you see silver dropping and you feel that fear in your stomach, I need you to remember what we talked about in this video. Remember the Japan shock. Remember that the global ATM is closed. Remember that the liquidity tide is going out for the paper financial system, but coming in for the physical real asset system. Do not let short-term volatility steal your position. If you own physical silver, if you're not using leverage, if you're not trading on margin, you can ride out any storm. The only people who get hurt on a roller coaster are the ones who jump off in the middle of the ride. Stay in your seat, hold your position, be patient. Here's my final verdict on what the Japanese 30-year yield hitting 3.5% really means. It's the pin that pops the everything bubble. It marks the definitive end of the cheap money era that we've lived through for 2 decades. It forces capital from around the world to flow back home. And most importantly, it forces the Federal Reserve to print US dollars into oblivion just to keep the Treasury market functioning. For anyone who owns silver, for anyone who understands what's happening, this is the macro catalyst we've been waiting for. We have the industrial shortage story with electric vehicles and solar panels. We have the geopolitical tension with supply chain disruptions. And now we have this massive macro tailwind with Japan and the bond market crisis. All 3 pillars of a bull market are in place simultaneously. The only thing holding silver prices down at this point is paper manipulation in the futures market. But paper contracts burn when interest rates rise and liquidity dries up. The physical market is what matters, and the physical market is getting extremely tight. You've positioned yourself correctly if you're holding physical silver. You understood these debt dynamics before the mainstream media started paying attention. Now you just need patience while the math plays out. The yen is moving, the bonds are breaking, the banks are stressed, the Fed is cornered, and silver is next in line for a massive repricing. This is happening. This is real. This isn't speculation anymore. The 30-year yield at 3.5% is the proof that the old system is dying. If you made it this far in the video, thank you for watching. Seriously, thank you. This is complex material, and I appreciate you taking the time to understand what is really happening in the financial system. Do me 3 favors before you go. First, subscribe to Money Aftermath if you haven't already. I'm going to be covering these developments as they unfold, and you don't want to miss what comes next. Second, drop a comment below and let me know what you think. Are you buying silver? Are you preparing? What's your strategy? I want to hear from you. And third, share this video. Send it to a friend, post it on social media, help spread this information because the mainstream media is not covering this properly, and people need to know what's coming. The repricing event has begun. The financial earthquake that started in Tokyo is spreading around the world, and the people who understand what's happening, the people who position themselves correctly, are going to come out of this in a much better place than those who ignored the warning signs. Stay informed, stay prepared, and I'll see you in the next video.